we've gone. Okay, there we go. All right, so I have got the recording on now. Before I say make the next point that I wanted to make, which was, so what I said was now we're in week 11 now. We've got classes up until including week 16. And then the week after that, the students write exams. And then there's 3 weeks over which the different exam papers are written. And then you have got 3 weeks of VAC before semester 2 starts. So some of the students were asking about the, what do they call it at head office? That roster that they've sent out for the students with all of your different classes, etc. Okay, and the different times and the different days of the week. So when they prepared that roster, they prepared it right at the beginning of the semester before we even knew what the PAS was and when the exams, etc. were going to be. And the lady that prepared it just put classes in, just going on until the dates, whatever. But we will only have classes until up to and including week 16. Okay, so live collabs will only go up to and including week 16. Then you write in exams, then no one's got time to attend lectures. You'll be busy studying, etc., and writing papers. So that's what we will do. So if on your rosters that you've got, you can just ignore any, and that goes across not only me, the other lecturers as well, just ignore anything that goes after week 16. If any lecturer is going to have an NSS for the exam in one of those weeks, then they will let you know as well. So just watch out for that, but that's also just a little bit of housekeeping. Oh no, who cried themselves to sleep? You didn't cry yourself to sleep with task 1, did you, Prema? I hope you didn't. You did very well. Most of you guys did well, and I'm hoping for a very nice task 2. You guys haven't got anything to worry about with your exams. Your exams are very nice, very fair, and I would say nice papers. I don't think you can complain with the exam paper. So as long as you obviously practice your work and you know your work and you've gone over questions and you understand those principles behind the questions, then you always will definitely get enough marks that you do well. Okay, so hopefully everybody has joined us now. So let's begin. So I'm going to go through a past paper, what I'm calling a mock task 2 with you this evening. So just to practice some like a model question paper. And I will post this question paper that I'm practicing with you tonight. I will put it up into your more resources for you, for those students that want to practice afterwards. So you'll be able to print it out and then sit with the recording and your printout and then practice it, and then obviously try and see if you can do the questions yourselves. Okay. So let me go and share the screen now and then open up that paper so we can start going through it. You guys, your task 2 is 100 marks. Okay, so your task 2 will be for 100 marks. And the one that we're going to use for practice tonight is only 60 marks, so it's a little bit shorter, but I like the questions on it. It's got the good basic principles on it, so you'll definitely be able to do some revision and ask any questions, etc. that you need to. Okay. So sharing my screen. Okay, so if you want to ask any questions, type it in the chat box. I'll be able to come back and check for questions, or otherwise just use your microphone, which will help me, because then if you've got a question, because then I'll be able to hear your question while we're looking at the question paper itself as well. Where do I want to go? All right. Yeah, I think I'm going to tile these because then you can see the question and the memo at the same time, which is helpful. Let's make this a bit smaller. And this one a bit smaller. Okay, and then we should be, okay, all right. So the first question, as you can see here, it's from Learning Unit 3. And remember this, your task 2 is Learning Units 3, 4, and 5. So it's our risk and return chapter, interest rates, bond valuation, and share valuations. That's what you've got to practice. We've got the first one, the manager of cruise investments, specializes in investments for clients who are nearing retirement age. They're analyzing whether to switch their clients' funds from their current investment in asset delta to a new asset, asset alpha. Provided us with the following information for asset alpha and have asked for our independent analysis. So this is asset alpha. This first column that's headed economic state. Remember in your textbooks, you've got those questions where they say if the economy is good, if it's bad, if it's very bad, etc. So that's the type of thing that they mean by with 1 to 5 economic state. 1 to 5 could also indicate year 1, year 2, year 3, etc. Your calculation would be the same. So for this question, they have given us return. But the return is not in rand value, it's in percentage value. So remember, sometimes in the question they will give you the return as in we had a return of 20,000 rand. Sometimes the return will be a return of 15%. Your calculations will be identical. And in this case, we have got a probability. So remember, sometimes for each different outcome, they can assign a probability, and in sometimes we get a return, possible returns, but they don't assign a probability to it. So you've got to know these different scenarios and different ways in which the information can be presented to you. So for the first question, they've just said quite simply, calculate the expected return for asset alpha. So also remember, when we do these calculations, you are either going to have a single asset or you are going to have a portfolio of assets. So here we've got asset alpha. It's a single asset. So we only need to worry about calculating the expected return for each one of these economic states, weighted for the probability, and then add the answers together, and that will give us our expected return. So if you have a look over here in the suggested solution, we have got a column for the return. And please, guys, make note that where one of the returns is negative, that you keep it negative and you make sure that your answer here in the expected return column is also still negative, and that when you add this column up to get your final expected value, that you have included that amount as a negative and the others as positives. That's one of the common errors that students make, and then they lose marks in that way. So all we're doing here is we are saying 15% multiplied by 20%. So as we're taking 20% of 15%. So of that 15%, the weighted value of it is 3%. 10% of 8%, so the weighted value of the 8% return is going to be 0.8%. And so on. Each probability multiplied by its return, giving us the weighted return for that particular year or economic situation. Add the weighted returns up, and that gives us our expected value. So our expected value is essentially a weighted average of the different returns over the different scenarios that we can expect. So overall, the expected return of this asset is 5.15%. Okay. So these things look simple, but there are a lot of principles and applications that you've got to remember as you're doing these. And the only way that you're going to get those right and so that they're second nature and you don't forget them is by practicing these questions. Then the second one is calculate the standard deviation for asset alpha. So again, remember, you will have the formula for standard deviation on your formula sheet. And also remember, as we practiced in our collab, that for standard deviation, there are two formulas on your formula sheet, and you have to know which of those two formulas to use depending on what format the question has been presented to you in. So if you've got your formula sheet printed out somewhere, I don't think I've got it loaded on the in the collab. The first standard deviation formula includes an option for probability, and the second formula does not include an option for probability. So if they have given you a probability in your data regarding the asset or the portfolio, you're going to use the first formula, which says the sum of P times R minus RE squared. And that P stands for probability. And then you take the square root of the sum of all of the different calculations that you do. If they did not give you a probability for each of these returns, then you would use the second formula, which has just got the sum of R minus RE squared over N minus 1. And then you take the square root of that sum of all of the different expected returns. Okay, so if you've got probability, you use the formula that's got the P in it. If there is no probability in your data, then you use the second formula that has got no P in it. So we have got a probability, so we're going to use the first formula. So according to our formula, it says take the probability, so this is P, and multiply it by the return of your asset, which is the RJ in the formula, subtracted from the expected return, which is the RE in the formula, square RJ minus RE, so 15 minus 5.15 squared, and that answer is multiplied by 0.2, and that is how we then calculate 19.4. Okay. So the second one, 0.10 multiplied by, open brackets, 8 minus 5.15 close brackets squared equals 0.81. And again, the purpose of squaring 5 minus 5.15 is that if you do have negative amounts in your returns, if you remember something multiply, if you square an amount, it just loses its that minus sign. So minus 5 minus 5.15 will give you an answer of minus 0.15. So minus 0.15 squared is plus whatever the answer is to that. So you end up with positives in all of these last column. Your answers will be positive because that's the whole purpose of squaring this RJ minus RE, is to get rid of pluses and minuses. Because what we're trying to measure there is the size of the deviation from the expected return. And we don't care whether the deviation from the expected return is greater than the expected return or whether it's less than the expected return. We just want to know by how much does it differ from the expected return. Okay, and then when you've calculated each one of those, you add up that column to get the total variance, 68.33. And then our formula says once we have summed all of the PJ multiplied by RJ minus RE squared, we then take the square root of that total. Total variance, and then the square root of 68.33, and then 8.27 is our standard deviation. Okay. This variance will always be positive. These will always be positive. Your standard deviation will also always be positive, 8.27%. So that means that the actual returns of each individual outcome could be 8.27% greater than the expected return, or it could be 8.27% less than the expected return. All we're measuring there is the relative size of the deviation, whether it's greater or lesser. Okay, does that make sense? Sometimes just to understand the maths and how it works also always helps you to remember to do the calculations when you are actually doing them, rather than just trying to do them, memorizing them and just doing them without knowing what you're doing. Okay. And then our 1.1.3 is calculate the coefficient of variation for asset alpha. So again, that coefficient of variation formula is on your formula sheet. And that is merely the standard deviation divided by, here we've got the standard deviation that we've calculated, divided by or over the expected return. So here 8.27, which is a standard deviation, over 5.15, which was the expected return, equals 1.61. And what we're calculating there, remember the standard deviation is as we said, it's the size of the difference that we can expect. And the standard deviation measures risk, because remember when we said that can you remember what that word was we used for measuring risk? We said that the range, the size of the range indicates the amount of risk. So basically standard deviation, we've calculated the size of the range. How far is our deviation from the expected return? What is the distance, the greatest distance, or the average distance? So we're saying and expected return is obviously 5.15% return. So we're saying how many units of risk are there for this asset per unit of return. So the 1.61 says that there is 1.61 units of risk, standard deviation, per each unit, each percent of return that I'm going to get. So if we calculate coefficient of variation for 5 different assets, that means it then makes it easier to compare those 5 different assets to each other to make a decision as to which one we are going to invest in as an investor. So remember, in these questions, we're just measuring one, but the purpose of doing this is so that you've got a measurement that's comparative across lots of different assets. Let me just have a look. Did they ask you over here, calculate the coefficient of variation and advise? So here you had to do the calculation, but then in addition to that, you had to also advise whether they should switch their client's investment. Remember at the top here, they said, we currently invested in asset delta, and we are now going to compare asset delta to asset alpha to decide whether we're going to sell our investment in asset delta and rather invest in asset alpha. Asset delta has got an expected return of 4.5% and a coefficient of variation of 0.45. So if we compare that to our asset alpha has got an expected return of 5.15 as opposed to 4.5, and it's got a coefficient of variation of 1.61 as opposed to 0.45. So you've got to use those two metrics that they gave you compare them to the two that you've calculated, and then explain how you would go about making that decision. So we're going to say over here that even though asset alpha has a higher expected return of 5.15 compared to asset delta's 4.5%, it is a much higher risk asset because it has got a coefficient of variation of 1.61 units of risk per unit of return, versus asset delta has only got 0.45 units of risk per unit of return. Okay, so therefore, because, and again, you've got to always have a look at your client. Are they risk neutral? Are they risk taking, or are they risk averse? So in the question here, they told you that your client is nearing retirement age. So a client that's nearing retirement age definitely doesn't want to take on any risky investments at this stage of the game, because they want to know that their retirement nest egg is safe and that they can retire in peace. So you bring that into your answer as well, because as their clients are near retirement age, the emphasis would be to preserve their capital and invest in risk-averse assets. So therefore, they should stick with asset delta. So this is a really lovely question to show how you can do the calculations, which is fine, well and good. We can all do the maths, but now can you apply what you know about what the standard deviation and coefficient of return and expected return, what do those calculations actually mean, and how can we translate them into a meaningful advice for our client? Okay, I'm just going to come over here and just see if anybody's got any questions. Okay. Okay, so Cameron says he's worried about the layout of the task because the layout for task 1 was confusing. I remember you mentioned that in the last collab as well. So Cameron, try not to worry about something like that. Remember, it's just the formatting of the questions in terms of how they've formatted it in Word. You're looking for that the information that they've given you about whatever calculation you've got to do. That's really what you're trying to extract. And always go first thing to the question and read the required, so that you know exactly what is required of you to go and extract out of all the information that they've given you. That always helps to make sense of the question. And yes, students every year, they say, oh, the question paper isn't like any of the past papers. And I promise you guys, the question papers are never going to be exactly like past papers. The whole purpose that the examiners do is to change them up all of the time, so that students aren't just regurgitating something that they've memorized from a past paper. Especially for third years, we are testing that a student understands the purpose and the principles behind the calculations that they're doing, it, that they can apply those concepts and principles to the calculations and then to the interpretation of the answers that we get to the calculation. That's really what's important. And remember, as I said also to somebody asked last time, this textbook and this curriculum and even financial management, these calculations and formulas haven't changed since the day they were invented, which is, I don't know when they were invented, but these calculations have been in existence for decades. So it's not new work. So where you look at past papers, they're all looking at the same basic formulas and principles that we use as financial managers when we are comparing one asset to another asset. So even when I did financial management and calculations, I can't remember, they called it something different way back when I studied. It's the same formulas. There's nothing has changed in that. So just let that give you a little bit of comfort. Okay, it's not new work. They're not going to reinvent the formulas. It's always the same. Okay, Cameron, I hope you are still with us, and no, Prema, you're not going to cry yourself to sleep. Okay. All right, so everybody ready? Let's go back and then have a look at the question 1.2. Let's go back here. Okay, so 1.2, we're still sticking with learning unit 3. And here we have got, just do this. Cruise Investments has also asked us to analyze a well-established company, Neptune Limited, and has asked us whether it represents a buy opportunity. So the company Neptune Limited, they want us to have a look at this particular asset and then advise as to whether it would be a good investment or not. We've determined that Neptune Limited has got a beta coefficient of 2.5 times the market beta. Okay. The market risk premium is 2% and the risk-free rate is 5%. With that information, the beta, a risk-free rate, and a market risk premium, what formula do you guys have in your repertoire that you know that we use that information? Yes, exactly. So when you read the information, you should immediately say, okay, so they want me to do a CAPM calculation here. Okay. And let me just triple check here quickly. CAPM formula, where is it? Is on your formula sheet. So this is where you need to know your work so well that as soon as you see that, you go, okay, so that's CAPM formula. Here's my formula. Let me put that information into the formula so that I can calculate whatever the missing variable is. So remember, in your CAPM formula, you have got, it calculates required rate of return. RJ is required rate of return, or capital cost, is equal to the risk-free rate of return plus the beta of the asset that you are trying to measure multiplied by, and then in brackets, the return of the market minus the risk-free rate of return. So RM minus RF equals what? What do we call that answer? And again, if you go and have a look at the information that they've given us, I want this one. They haven't given us the market return. We've got the beta of our company, we've got the risk-free rate, but then they've said the risk premium. So what is the risk premium? What is the risk premium? Yes, RM minus RF, which is that part of the formula, equals the risk premium. So what we're saying there is that the amount by which the market return exceeds the risk-free rate, that is the risk premium of the market. So in other words, the market has taken the risk-free rate of return and they have added to that an amount for additional risk which occurs in the general market, which are not risk-free assets. So you must also know that, because otherwise if they give you the risk premium and you go and have a look at the CAPM formula on your formula sheet, you're not going to know what to do with the risk premium. So we have got 5, the risk-free rate of return, RF plus beta. So what is the market rate of return? In our question as well, they said the beta, it's got a beta of 2.5 times the market beta. What is the market beta? What value is the market beta? Always, the market beta is always the same value. What is it? What is that value? What is that constant value of market beta? Because again, if you don't know that, you won't be able to calculate the market beta times 2.5. Because they said this company is, their beta is 2.5 times that of the market beta. And if you don't know what the market beta is, you can't calculate the beta that you need to put into your CAPM formula. This is an easy one, guys. Easy one to remember. Our base market beta is always 1. Okay? The base of the market beta is 1. We say market beta is 1, and then we measure the beta of all the different companies, individual companies and assets that we are looking at relative to 1. So when we say market beta, again, it's like an index. We're saying the index for the market beta is 1, and then we measure all the other companies relative to that. So then that means that our company's beta is going to be 2.5 times 1. Okay. So RF 5% plus 2.5, which is the beta of our Neptune company. And then the formula says multiplied by, open brackets, RM minus RF. And because we know that RM minus RF is the market premium, we just put our 2% which they gave us in the question in those brackets. And then we can calculate that the required rate of return, or the cost of capital, cost of equity, or whatever they want to call it for this company, is 10%. Okay. So calculate the cost of equity using the capital asset pricing model. Sometimes they won't tell you to use the CAPM model. They'll just say calculate the cost of equity for Neptune. And then you have to know that you must use the CAPM formula. Now, the next question says, with reference to the cost of equity calculated in 1.2.1, so in other words, using your answer to 1.2.1, use the dividend growth model, okay, to advise Cruise Investment whether they should purchase the shares in Neptune if the shares of Neptune are currently trading on the JSE at 50 Rand per share. Okay, so what is our learning unit? This is going to be learning unit 5, share valuation. We now have to use one of our share valuation formulas to calculate what the formula tells us the value for one share in Neptune is, and then we're going to compare that to 50 Rand and then decide whether 50 Rand is a bargain or whether it's expensive when we compare it to our calculation. And again, you've got to have a look at what information have they given us for this asset Neptune. We now know what the cost of capital is, or the required rate of return. All that they've given us is the last 4 years worth of dividend information. We know what the last 4 years dividends were that were paid out. And they've told us dividend history has been provided. It is expected that dividends will grow at the same constant rate achieved over the past 4 years in the future. So they've told us, use the dividend growth model. They've told us that dividends are going to grow at the same constant rate into the future. So which formula are we going to use? Remember, dividend growth model, there are two formulas. Which one of the two formulas are we going to use based on the information that we've got in this question? Because remember, the data that you're given is always going to dictate which of the formulas you're going to use. So which of the two formulas are we going to use? Yes. Prema's got it. And that is called the dividend growth model for constant growth, as opposed to variable growth. So those are the two formulas we've got. One's for constant growth and the other one is for variable growth. They told us that this dividend that they've given us is constant growth. So therefore, we're going to use that first formula, PO, which means the price of one share is equal to D1 over K minus G. Now you know what formula you're going to, you never know, but don't worry, you've got the formulas for both of them and you know how they work. So don't worry about that. And if you've practiced and you know how to identify each variable, you'll be fine. So now we know which formula we're going to use. Now we have to work out, we have to say, okay, my formula is D1 over K minus G. So now I've got to work out what is my value for D1. What is my value for K? What is my value for G? With each one of these now, you've probably got to go and do a little calculation so that we can then put it all together to work out the price of that share. Okay? Yes, and where did you get K from? Where did we get K from? K we've got 100% correct. Yes, exactly. K is our required rate of return. So we've already calculated K in 2.1. Sorry, not 2.1, in 1.2, 1.2.1. So we've got K. We now, how are we going to calculate G? With the information that they've given to us, how are we going to calculate G? This is what we've got. How do we calculate G? G is the growth rate, which means it's a percentage. So we want to know, they said our dividends are going to grow at the same rate that they have over these last 4 years. So how do we calculate the percentage growth rate that these dividends have grown at from 2016 through to 2019? This formula you will find in your LU2 in the section called Finding Growth Rates. Do you remember that? Anybody remember that? Let's go and have a look. Okay, so we've got the financial calculator version here on the screen. If you go to your Learning Unit 2 and find that section, it's right towards the end of Learning Unit 2, those alternative calculations. You'll find the what you call it, formula or just normal calculator version and not the financial calculator version. So what we are doing here is we are taking the oldest dividend, which is R3.80, and we're saying that is the present value, and we're calling it the present value because it was the original dividend from the past. You can also sometimes say P for past. P for past and P for present is R3.80. The very latest dividend was R4.15, so that was the future. So the oldest dividend in the past was R3.80. The newest dividend in the future was R4.15. And remember, when we've got a present value and a future value, you must always enter the present value as a negative in the financial calculator. And that's just the financial calculator thing, that it wants the present value as a negative. Otherwise, it can't do the calculation properly. Then we want to know the value for N. How many periods of growth were there from 2016 to 2019? So take note what I said. How many periods of growth were there? Not how many years worth of dividends did they give us? In other words, we want to say how many times did the dividends grow? So if you have a look, they grew once from 2016 to 2017, then a second time from 2017 to 2018, and a third time from 2018 to 2019. So the dividends grew 3 times. So N is 3, not 4. Okay, and that's made clear in your LU2 section as well. And then comp I, and we get 2.98% as the growth rate in our dividends from 2016 through to 2019. Okay. Now we know the growth rate. We know the value for required rate of return for K. We've got K and we've got G. We can easily work out D, D1. So D1 says take the last dividend, which would be 2019's dividend of R4.15, and apply the growth rate to it, because 2019 R4.15 will be D0, dividend at time 0, the last dividend that we received. In our formula, we want D1. Oh, come on. There we go. We want D1. Okay. And then this is going to be K minus G. So we take the last dividend that they gave us, R4.15, and we apply the growth rate that we've just worked out to doesn't want to work. And we apply it to the last dividends. In other words, we work out what will the next dividend be. So the next dividend is going to be R4.15 times 1.0298. In other words, it's going to grow by 2.98%. And then we've worked out all 3 variables that we need for that formula, and then we can work out that PO equals R60.88. So given the market data that we've got about, what was this, the name of this Neptune, the shares in Neptune, given the data that we've got about this particular share, we work out that the value for the share, a fair value for the share, is R60.88. They've told us that currently the share is trading at R50. So in other words, I can go to the JSE at the moment and I can buy a share in Neptune for R50. But I've worked out that a share in Neptune is actually worth R60.88. So that R50 is actually a bargain. So we are going to say the advice is go ahead and purchase the share because it's currently undervalued at R50 on the JSE when compared to its calculated valuation of R60.88. Okay. Does that make sense? And also, you see how you've got to do the calculations, but then you also need to be able to explain why you are giving certain advice. Decide what the advice should be, and then explain Not just give the advice, but explain why you decided that. Any questions on that lot so far? I'm going quite slowly with these calculations so that we can really break it down, so it helps you to revise all of the principles and the formulas and why we do it and how you make the decisions. Everybody happy? Am I going too slowly? Am I going too fast? Are you completely lost? Are you with me? Okay. And guys, if whatever questions we don't finish in this paper, I will record for you later in the week and then post those that recording for you as well. Because we probably won't finish in our hour tonight, because the paper goes up to, I think it's question 4. Okay. So we'll just go as far as we can, and then I'll record the rest for you. Okay, and those guys with no response, those who haven't responded, are you just watching Netflix, or are you could tell me if it's, should I go faster? Am I going too slowly? Okay. Half of you are happy and half of you are undecided. Okay, so let's go to the next question then. All right, so now we're going to go question 2. And question 2 is learning unit 4, which is our bond valuation question. Interest rates and bond valuation. Sorry, just need to take a sip of my tea. Okay, so first question, calculate the real rate of interest using Fisher's formula. And I told you guys they love Fisher's formula in tests. If the nominal rate of interest is expected to be 16.5% and inflation is expected to be 1/3 of the nominal rate. Okay, so you will have open book for your task, so you'll be able to look up Fisher's formula. But remember, in the exam, Fisher's formula is not on your formula sheet. So for those of you who have forgotten, see, Fisher's formula is 1 plus I, with I being the nominal rate, is equal to 1 plus R, with R being the real rate, multiplied by 1 plus H, and H stands for the rate of inflation. So then you will take this formula, you will insert in the formula those values that you have got, and you will solve for R, real rate of interest, 1 plus R. So we've got to solve for 1 plus R. So have a look on the right-hand side here. So nominal rate is 16.5%. They gave us that. Equals 1 plus R. That's what we're going to have to calculate. We don't know that. And 1 plus H told us that inflation rate is 1/3 of 16.5. So that is where that comes from. And then just using algebra, and I'm not going to take the time to type that all out. You basically want to isolate 1 plus R by itself on one side of the equation, and then work out the other side, and then we take R by itself by taking the 1 to the other side as a -1, and then we can solve for the value for R. And R is the real rate of interest, which we then calculate to be 10.43%. Okay. Then our client, Mr. Stokes, has approached us for advice as to whether he should purchase bonds in Renew Limited, who is on a major expansion drive and are urgently requiring financing, so they are trying to sell bonds like mad. They are offering the following bond to investors via online applications. Okay, so the bond that we can purchase has got a par value of 50,000 Rand. So as you're reading this, remember, try and fill in what your variable is that you would use that for in your either your formula or your financial calculator. The par value is the future value of the bond at its maturity date. The price of the bond today is the par value discounted by 5%. So that is the present value. What if I bought a bond today, what would I pay for it? The coupon percentage, which is the fixed rate of interest that I will be paid if I purchase one of these bonds. So that is the repetitive interest payment I will receive, which is the PMT. The number of years that the bond has got until maturity is 20. And interest is going to be paid quarterly, so I will use that for M, number of times that interest compounds in a year. Okay, does that make sense? So as you're reading the paper, you are going to be jotting things like this down and identifying clearly. So now we've identified everything I've got. I've got a future value, a present value, a PMT. I've got an N and an M, and what's missing? What haven't I got? I don't have a value for R, the return that this bond will give me if given these circumstances. So they said, advise Mr. Stokes whether he should purchase the bond, knowing from your dealings with him that he has got a required rate of return of 13.5% for his investments. So what are we going to do? We are going to calculate the value for R. In other words, what return will this bond give me if I purchase it at this particular price today? And then you're going to compare the return of the bond to Mr. Stokes's required rate of 13.5 and then advise him. So if you have a look at the right-hand side of the screen here, we've got the financial calculator version. But remember, you've got the bond valuation formula on your formula sheet as well. So you can also take with these exact same variable names, excepting for par value in the, if you're using the actual formula, the par value, oh, sorry, I want this one. If you're using the formula, that's capital M. Okay, but everything else would be the same in the bond valuation formula. We've got PMT, and this one here, present value, that would be in our formula B0, the price of the bond today. PMT is the same, calculator or formula. N is the same, and this small m would be the same. Okay, so just take note that the price of the bond today is B0, which is in our formula, the price of the bond today is equal to PMT times whatever the formula is. Okay, so always know what your variable names are, so you can always take the information that's been given to you and either put it into a financial calculator version or the formula version. So you program into your calculator FV equals 50,000. N is going to remember, because interest is being paid quarterly, that is going to be N times M. PMT, it's 14% per annum. So we take 50,000 Rand, multiply it by 14%. That will give us the whole year's worth of interest. But because they are going to pay it to us quarterly, we have to divide that by 4, so that each one of the 4 times that we receive interest from the bond during the year, the amount we receive will be 1,750. Present value is 95% of the par value of the bond because it's selling at a discount of 5%. And then comp I, you'll get an answer of 3.7, but remember that 3.7 will be for only one of those interest payments that you receive, because we've said 20 years times 4, 80 payments. Each individual payment will be 1,750, which is a return of 3.7% for that one payment. So we must multiply that by 4 to get a full year's return. Okay, so they've said here 14.8 or 14.78 rounding. Always round to 2 decimal places. Do not round to whole numbers in finance. So then they said that Mr. Stokes has got a required rate of return of 13.5%. So we can say, yes, go ahead and purchase the bond because it's got a yield to maturity of 14.8%. You must give a reason which is higher than his required rate of 13.5%. So this is the same as calculating the IRR. Remember, the internal rate of return of the bond or the yield to maturity. Those terms are kind of interchangeable. In other words, we've calculated what the return of the bond would be if we paid 47,500 Rand for it today. My return would then be 14.8%. Okay. Everybody happy with that? Any questions with that particular calculation? I'm going to stop at the end of this 2.2 and I'll record the rest because we have got to 7 p.m. now and you guys might have another session at 7:30. And question 3 will take longer than just another 10 minutes or so. So I don't want to rush with that. Well, hopefully it will be, guys. I don't know. But remember, the calculations are the same. Bond valuation formula, yes. You were asking about question 2, yes. So that formula that says B0 is equal to PMT times whatever. Because remember, B0 is saying what is the value of one bond. In other words, what price would be a fair price to pay for one bond. And in the share valuation formulas, that formula says P0 is equal to blah, blah, blah. And P0 stands for the price of one share. So BO is the price of one bond and PO is the price of one share. And sometimes they make you work a little harder to calculate each of the values of the different variables. So just remember, they have to give you the information that you require in the question to do these calculations. All the information that you need has to be in the question. So always just be confident it's in there somewhere. You've got your formula sheet, you've got your open book textbook, and I'll try and give you, when did I say you guys are writing? Next Monday, hey? You've got to write on Monday. Yeah, you'll be writing on Monday. So I'll try to give you as much information before Monday that you can go and have a look at various questions, etc. Yeah, this wasn't a bad paper. But again, it's an easy paper if you know what to do. If you didn't know what to do with this information, which formula to use, if you didn't know which variable each of those amounts given to you fitted into the various formulas, then it's not an easy paper. So if you're saying it's easy, then that means you know your work, and that makes me happy. Then it means you're actually getting to know your formulas and how to work with them. You see, so don't be nervous because it seems easy. Okay, guys, I'm going to end the recording here.